Okay, so hi everyone and welcome to our August webinar. We've got Claire with us today with her presentation on preserving family wealth. We think that the presentation should last around 30 minutes and then obviously we will leave some time at the end to go through any questions that you might have for Claire or anything that you might want clarifying as we go through. There is the chat pod over on the right hand side, so if you do have any questions, just pop them in there and we will read those out at the end of the presentation. There will be a short survey as well at the very end as well, so I'll leave that up for about 5 minutes. So if you do have a minute of time just to leave that feedback for us, we will really appreciate that. Otherwise, Claire, I'll leave it to you.
Perfect, thanks Jess. Cool, so hey everyone. Starting off, as always, with a risk disclaimer. So lots of what I'm going to talk about today is very reliant on legislation, which is, it is being discussed at the moment. It's in consultation, so I'll highlight where that is, but to, further highlight that it is liable to changes in the future. Investments obviously can go up and down, and this is not suitable for everyone. So yeah, throughout this presentation, I would advise, further guidance and advice and discussions with your advisor. So I think most of you know who I am, but yeah, quick overview. I've been with AWM for 11 years now, and this is one of my core topics. So as an introduction, I will be running over in general and sort of covering off the importance of long-term wealth preservation. Within that, I'll be looking at the key risks. Those key risks are generally taxation, poor planning, so poor succession planning. And of course, when this topic comes into discussion, there is lots of family disputes that can disrupt, some really careful and considerate planning opportunities. So the objectives of this, we are going to run over the objectives and how you mitigate those. So the tools that are available to you in the form of trusts, gifts, and business relief. And the overall objective of this webinar, you should be able to, see the difference between the tax efficiency side of the planning versus, the family protection side, because, overall they don't always sit hand in hand, but, careful consideration and, collective planning on both fronts, you can make both sides very, very efficient. So the landscape that we're in at the moment, which makes this a very topical webinar, we all have lots of, IHT liabilities. The IHT liabilities are rising for everyone. Life expectancy is also getting longer. People are enjoying longer retirements. With that, there's lots of blended families out there with, complex needs. And alongside all of those things, the regulatory environment that forms the legislation that sits behind all of this planning is under consultation. As I said, it is getting tighter. The regulatory environment is getting a bit more stringent and a bit more focused on, tax and inheritance tax exemptions. So an IHT refresher. So we have everyone in the UK has a nil rate band of 325,000. There was also an introduction of a residence nil rate band. So the residence nil rate band is available if you pass your main residence down to direct descendants. So on a very, very simplistic level, you get an additional £175,000 of nil rate band for passing your main residence to those direct descendants. And that is fixed until 2030. There is a taper on this. So individual estates that are over 2 million, so net estates over 2 million, will be sacrificing some of that residence nil rate band. So how that works is you sacrifice £1 of the nil rate band for every £2 over the 2 million value that you have. Again, to simplify things, so on second death, if you're spouses, so on second death between couples, if the net estate of that, the surviving spouse is over 2.7 million, there will be no residence nil rate band. Back to a simpler topic, the IHG rate is 40%, so above those allowances that you've got, so the nil rate band, residence nil rate band if applicable, everything above that is taxable at 40%. There is currently no capital gains tax calculation or consideration on death, i.e. any gains that you have currently would, die with you as an individual. So trusts, quick recap on what trusts are. So lots and lots of different types of trusts. Trusts ultimately allow control over distribution. They are primarily used for asset protection, and asset protection is for things, events such as divorce, creditor claims, bankruptcy, mismanagement of family funds, and all of those things that kind of sit around those scenarios. Trusts also provide lots of tax planning opportunities. So the core trusts we will be covering today are these three: discretionary trusts, bare trusts, and interest in possession trusts. There are lots and lots of different types of those and applications of these, which I don't have time in 30 minutes to go over, but those are the core baseline trusts that you probably have encountered, heard of, seen in the news. Those trusts, so discretionary trusts and bare trusts, fall under the relevant property regime. So the relevant property regime is important in understanding what's happening in current legislative changes. So the relevant property regime includes legislation around an entry charge, a 10-year anniversary charge, exit charges. Those charges can be applicable and are applicable to trusts. So careful planning is needed. The 10-year anniversary charge exists when there is no interest in possession. So the interest in possession is core to understand. The interest in possession is where an individual, a beneficiary of that trust, has a life interest in the contents of that trust. Core application of this is going to be where your family home is passed into a trust and your surviving spouse has that life interest in that residence. So that is the core, where this applies. So where that applies, there's no 10-year anniversary charge, there's no exit charge in those scenarios. If that doesn't apply, you will see the implications of that, but there are no, where there is no interest, there would be 10-year anniversary charges. A trust, even though complex, understanding the nuances of trusts can be difficult, but they can be very, very, very beneficial to you. So trusts not only, going back to the previous slide, protect against, divorces, bankruptcy, spillages, or, outside of the bloodline. So, you can ensure protection for your wealth, for your bloodline by using a trust. And you can do that in your lifetime as well as after death. So within your lifetime, we use discretionary trusts such as family gift trusts. We use those and they can receive gifts of your nil rate band every 7 years. So they can benefit you because in your lifetime, if you've made that gift, you still would want to maintain some level of control over, what happens with that money. So you can maintain your position as the trustee. That means you have, the overriding rights on what happens with that trust, i.e. where that money is invested, who gets the benefit and when. And you can change the beneficiaries at any time in your lifetime. So you as a trustee can retain that. Obviously, we're talking about the preserving the family wealth. So, you would want your bloodline to be the beneficiary. You want to preserve it, exempt it from inheritance tax. You can gift into a trust, and you can do that or up to an amount of your nil rate band, and your nil rate band refreshes every 7 years. That after that 7 years, that gift is outside of your estate, not liable to inheritance tax. Therefore, it is there, the full amount is there for your beneficiaries, and that can grow through your lifetime, or they can take benefit from it. The reason I've put that last bullet point, so gifts, even if immediately before death, can reduce the estate value for residents' nil rate band. So this is going to be quite a core conversation with lots and lots of individuals, because gifts made, the day before your death, a year before your death, we historically have spoken gifts in the sense of exempting from inheritance tax. However, you can make a gift, a strategical gift, at the last points of your life in the attempt to regain the residence nil rate band. So right back to the start, the residence nil rate band is available of estates up to 2 million. So, if you've got an estate of 2,100,000, gifting that 100,000, a week before your death, if we could predict that, it would be wonderful. However, if you did that 100,000 would still be liable for inheritance tax because it hasn't met that 7 year exemption clock. But your net estate, when you look at the calculation for the residence nil rate band, would be below that £2 million. So you would qualify for the full residence nil rate band. So larger gifting is becoming more conversational now, not just gifting the nil rate band. Larger gifts, when made into trust, you can retain that control, and that is a core use of trusts. So after death, trusts can be used again. So, within your wills and your wishes after after your death, you can use trusts. The interest in possession aspect that I said, so the surviving spouse, having that life interest in the main residence enables you to utilize a trust and claim the residence nil rate band. It also allows you to protect the family wealth from, that wealth being spread out around outside of your bloodline. So, if you name beneficiaries, i.e. your children and your grandchildren, however they engage in life, whether they get married, divorced, any unforeseen situation, a trust can protect against that because it is for their sole benefit and their sole benefit only. So that benefit doesn't spread to spouses, but you can put stipulations in there. You can have a memorandum of wishes that says you want this money to be used for education and medical purposes, things like that, so that if there are particular wishes or controls that you want to have in place, a trust can do that and can protect for multiple generations that come after you. So with gifting, I see there was already a question on that, but with gifting, you have lots of exemptions. So the one exemption that I said before was the potentially exempt transfer, that is the gift or chargeable lifetime transfer in the sense of putting it into trust. That is the gift of your nil rate band in a 7-year cycle to an individual or to a trust. So the potentially exempt transfer could be any amount, and that would go to an individual, not a trust. But those both of those cover off that 7-year rule. So that's gift is made day one. 7 years on the anniversary of that gift, you then have that amount outside of your estate for the purposes of inheritance tax. As I said, that transfer outside of your estate from day one because it is a gift, it's no longer yours. So it's no longer part of your, net estate calculation. On inheritance tax exposure, it is exposed to inheritance tax for 7 years. The others on this list are immediately exempt from inheritance tax. So we have the annual exemption. So every individual in the UK has an annual exemption of £3,000 a year. So that gift of £3,000 a year in value can go to anyone. It can go to trust. It could go to an individual. That gift is immediately exempt. The small gift allowance, which I get lots and lots of questions on. The small gift allowance is £250 per person per gift. So essentially what it means, the legislation says you can gift any amount of individuals £250 in a tax year, and that is immediately exempt. So if you were lucky enough to have 1,000 friends, you could give them all £250 every tax year, and that £250 to that 1,000 people is immediately exempt. Of course, that is not very real scenario, but that £250 per person covers things, birthday gifts, Christmas gifts, things like that, well done, congratulations, anything like that, those monetary value gifts are exempted under that allowance. The ones that are not so regularly used, so the wedding gift allowance. So the wedding gift allowance is written into legislation. So you can give £5,000 per child, £2,500 for grandchildren or great-grandchildren, and £1,000 to anyone else as a wedding gift. So that wedding gift exemption sits alongside these. They can be used in unison. They can all be used together. And the final one, which I'll focus a lot more on in this webinar, is the regular gifts out of income. So the regular gifts out of income, otherwise known as gifting out of normal expenditure, I think is a very underused exemption, and can be utilised a lot more, and I think will be utilised a lot more. Life insurance. So life insurance, again, I think is very, very, very underused in the sense of inheritance tax planning and, generational wealth planning, preserving that wealth for, passing it down. It's often overlooked, and I will come onto a scenario later in the webinar that will show this. But ultimately, the premium is exempted under the gifting out of normal expenditure. And if you took financial advice, the advice that I would 99% of the time give is that policy is written into trust immediately. So, your gifting out of normal expenditure is the exemption, so that regular premium is outside of your estate. Then the benefit is protected for all the reasons that I went over with trust. The benefit is protected for your bloodline from the outset because there is a trust involved. Pensions and inheritance tax. So pensions and inheritance tax, I'm sure all of you saw, the news, the last budget. So pensions will fall inside someone's taxable estate from April 2027. So that is, that is going to be there. The value of your pension is included in your estate for purposes of calculating your eligibility for the residence nil rate band. Historically and today, pensions are not included in any estate calculation, and they are not included in the scope of inheritance tax. So to put this into perspective, this next slide is just a table that shows that in practice. So current system, if you've got an estate of 2 million, you have a joint estate of 2 million. We're looking at second death here. So you've got your nil rate bands, 2 nil rate bands, 650. And then you have 2 sets of residence nil rate band that you're eligible for. So that's 350. So £1 million is your basic, £2 million taxable estate. £1 million is your exemptions. That's your allowance. Your taxable estate, therefore, is £1 million. And as I said right at the start, tax bill, 40% of that, so 400,000. After 2027, the pension, so in this scenario, I just put a £700,000 pension in, obviously to show what would happen. So you still get your basic nil rate band. So that's not changed. At that 2.7 million, you would lose all of the residence nil rate band. So you would sacrifice the whole residence nil rate band. So in that scenario, your taxable estate becomes £2,050,000, and 40% of that is £820,000. So just with the inclusion of the pension in the estate, you know, the IHT liability in this particular scenario has gone up by 105%. So that is the impact of that change in legislation. The other bit that's under consultation at the moment and is being written into legislation is a £1 million allowance for business relief and agricultural relief. I focused in on business relief, but everything I've said here is relevant to the agricultural relief exemption as well. So that allowance is there. I call it an allowance now because it's not transferable between spouses. So if you are someone that has business or agricultural assets, you know, the ownership of those now is crucially important, because you cannot pass you can't use spousal exemption on first death. Then the surviving spouse owns that asset. They would have their £1 million allowance, but you haven't used yours. So you haven't used yours on first death. You've passed it to the spouse, and your £1 million allowance essentially is unclaimed. So, you know, it is an allowance here, like an ISA allowance. You use it or you lose it at the time it's to be used. So that is kind of the current backdrop, the legislation, what's going on, and an overview of topics that I've got here. So this section will kind of look at, you know, what can you do, what are we discussing with clients at the moment. So wills. So having a will is really, really crucially important. So, you know, the will directing the assets where you want them to go is absolutely crucial to any of these solutions. If you don't have a will, your estate passes under the law of intestate. So you have no control over where it's going, and you know, things like the residence nil rate band, it needing to go to direct descendants, you know, things like that would be lost, because you know, in most senses it would go to spouse on first death. So having a will and, you know, carefully choosing your beneficiaries and making sure that they fit in with the current legislation and to be able to claim the current exemptions is really, really crucial. Integrating trusts into your will is, again, a way of adding that kind of layer of security after your death. You know, you can control the will, the trust to an extent, and the trust protects against generational inheritance tax. So a trust sitting in the middle of, you know, potentially you and your children, you know, client A has £1 million, child of client A has their own £1 million. If that £1 million comes down, you know, even using all exemptions, comes free of inheritance tax, passes to the child, you know, there is potential inheritance tax on that child and then thereafter. If there was a trust in the middle, that trust in the middle, you know, may not exempt it from inheritance tax on first death, but because it never passes directly to an individual, that trust would protect against the generational inheritance tax. So that, yeah, wills and trust planning, really, really crucial to make use of any of these exemptions. Pensions, again, so what can you do with pensions? You know, the pension changes are coming. They are coming in. Consultation currently, you know, the legislation hasn't been written. So what can you do now? What should you be thinking about now? So if you have a pension, are you in drawdown? Have you got an annuity? Is there a section of it you can annuitize, to provide income? Should you use Flexi Access Drawdown to take more than you need? The reason why we might take more than we need is in 2 slides later, but these are questions that we really should be asking. We should be asking anyone. Should I use my pension to fund a life assurance policy with a guaranteed premium that is going to end up in trust? A real question that each individual is going to have a different answer to, because they are very, very, lifestyle driven. It's very individual on, the rest of your estate, your other wealth there. Tax-free cash is core to think about. There's not a right or wrong answer. Should I fully take all my tax-free cash? Should I leave it in my pension? Should I take my cash and gift it away? Those are real questions and, real realities that I recommend are explored. If you are in a situation where you've already inherited a pension from someone, that pension has come to you outside of the scope of inheritance tax, because, that's how pensions were inherited previously. What should you be doing with that? Should you be taking regular income? Is it liable for income tax now? Is it going to be liable for inheritance tax in the future? How should I manage that? Again, very, very individual circumstances lead to, a personalized plan here, but pensions are flexible. Ultimately, if you are in Flexi Access Drawdown, you have the ability to manipulate when you get your income, when you pay your taxes, when you have that liability to income tax, and you have the option of tax-free cash. What you don't have is the option of whether this pension is going to be taxed in the future, because it is coming into the scope of inheritance tax. So these options now, really, really strongly recommend consideration of those, so that, you're acknowledging the changes that are to come. So gifting abnormal expenditure. So first use of your pension here. So if you are someone with a pension, a large pension, you could take additional drawdowns over and above what you need. That income is classed as, as income. It's taxable income. You could use that to fund children's, grandchildren's ISAs, junior ISAs, and pensions. And you could be using your pension to fund things like annual gifts. There is tax exposure on drawdown in some cases there's not. However, there is planning opportunity outside the pension once you've taken that. So gifting abnormal expenditure, as I said, I'll just go into a lot more detail because I think it's a very underused exemption. So HMRC conditions, these 3 all must be met for your money to be deemed income that can then be immediately exempt from inheritance tax. So made as normal expenditure. So HMRC look at the intention of the money, of the gifts. They look at, the regularity of them. They also look at whether they're out of income, not capital. So income, what classes as income, I think I have on the next slide, but, income is generally taxable. Withdrawing from ISAs, bonds, stock portfolios, and taking out of the capital, that is not classed as income. So you cannot sell investments, or, you can't sell investments in order to gift those away and expect them to be immediately exempt. Salary, dividends, pensions, rental income, all of those things, generally fall under the income. The third condition is that it doesn't reduce your standard of living. So what HMRC would do if they wanted to look into this is, look at how you were living, before you started making these gifts. Is your lifestyle the same? They will look at, bank statements, paying these premiums. Are you able to maintain gym memberships, for example, things like that. On a very small scale, but those are the three things that you would have to satisfy to say, yes, this is gifting out of normal expenditure and it's immediately exempt. So this is income. I will leave this up. I put this mainly in there for purposes of post-webinar downloads, but what classes as income is generally there. So as I said, rental, pensions, employment, salaries, sole trader, earned income, anything like that, classes of that income. A applied practical application here. So if you are in Flexi Access Drawdown, so FAD stands for Flexi Access Drawdown, you can control what you take on an annual basis. So what you take, may satisfy your needs. You may be spending it every month. So there could be scope, to take an extra £10,000 in a given tax year and be able to maintain your lifestyle, on a cash flow basis with your pension. So if you took another £10,000 and assuming, we are paying 40% tax on that, so your net income after tax would be £6,000 from that. If you were able to put that £6,000 into a child's pension, child, grandchild, anyone's pension, that gift, because it's come from income, we assume it's immediately exempt from inheritance tax. So that £6,000 gift is immediately outside of your estate. So that gift in a pension, if your child or grandchild is a basic rate taxpayer, your £6,000 becomes £7,500 in their pension, because they are able to claim, or we assume they are able to claim the income tax relief there. If your child or grandchild is a higher rate taxpayer, they would be able to claim another £1,500 back on their tax return. So they would get another a tax rebate from HMRC based on your gift. So you can see where you're starting to claim back that tax. In order for children to, grandchildren to be able to receive that pension, it's based on their lifestyle, their earnings. So it is very crucial, that families are considered here. And I think one of the core things here is, looking at intergenerational education and, discussing this within families becomes very, very important. Insurance, as I say, is another underused way of passing, or, a concept that we discuss when we say, passing on wealth and generational wealth preservation. So insurance there, as I said, gifting out of normal expenditure, the exemption that you pay your premiums. So insurance policies, you have your premium, usually paid monthly. That premium is written into legislation that it's exempt immediately from inheritance tax, even if the policy is written into trust. I would recommend most policies are written into trust, and therefore they are completely outside the scope of inheritance tax. Now, historically, I've come across some clients that say it's expensive, are not, we wouldn't really look to deplete a pension to fund an insurance premium. However, that is changing. The balance of arguments there could be swayed. So, is it becoming more prevalent to do this? In my opinion, yes. And in my opinion, I would say speak to advisors, get a real life example of what it would look like in your individual circumstances, because, tax, everyone's paying their own rate of tax and in their own sort of wider lifestyle. But in saying that, we can look at what's called a whole of life policy. So we have a guaranteed whole of life policy, and we can look at that like an investment provision. So the reason I'm saying that is, sorry, that's very blurry, but the reason I'm saying this, so this investment model we use, and I would use it to show clients what their annual premiums, so what they're paying into this policy for a guaranteed benefit, would look like. So in this specific model here, I have primarily just put a life expectancy of 81, because that's where we are at the moment. So a 40-year-old, 50-year-old, 60-year-old, a male and female in a joint policy, what they would cost per annum. So these are guaranteed for £1 million payout. So, you know, if you looked at the 60-year-old, you would need to be able to fund, you know, as an individual, you would need to be able to fund £16,401 for 21 years. You know, number one, planning, how do we do that? There are options available. However, when you then look at the, you know, when you look at the life expectancy and the return profile there, you know, that return profile is what you would have to get, or the equivalent that you would have to get. So I've done this male 81, the female's life expectancy is slightly higher. So the male at 60 would need to get an 8.32% return on that money every year. If we were equivalent, you know, if the equivalent of this, we were gifting it, well, we were contributing to it to a policy. Every single year for 21 years, it would need to earn 8.32% every single year to have that £1 million benefit at the end. So this is a very, very simplistic model in the sense that, you know, I haven't taken into account taxes and I don't take into account inheritance tax here at all. But that is the equivalent when you look at your insurance premiums versus the guaranteed payout. Business relief, again, is so that's the insurance. The business relief is under review. You know, the core planning opportunities that I would be thinking about here is, you know, do you own AIM shares? So AIM shares, you know, is there a benefit to keeping the AIM shares? You know, tossing up that and going back and forth, you know, with your advisor, looking at pros and cons of that. You have a £1 million allowance for, you know, non-AIM share BR now. So are you utilising that? Are we over the £1 million? Is there an overexposure to this? You know, can we use things like gifting into trust now or gifting away business relief assets now to make use of a rolling cycle of allowances here? You know, as I say, current consultation, current consultation says that, you know, every individual can gift away £1 million of BR per every 7 years without there being, you know, a lifetime charge and the relevant property regime rules coming into play. So that's where, you know, gifting of BR assets can be used. You know, we're talking about it a lot more. AIM shares also can be used as an investment model with the understanding that, you know, you don't get that full relief anymore. The final point from me is, because I've slightly overrun here, is there are lots of other types of trusts. So the trust that I generally are talking about previously is a family gift trust, which is a discretionary trust. In your lifetime, you can use discounted gift trusts and loan trusts. So discounted gift trusts, you know, if you as a donor or the settler of that trust are worried about income and you want to provision for yourself without gifting absolutely everything you have away, a discounted gift trust retains that income for the donor for the rest of the donor's life. A loan trust is slightly different, but allows flexibility again, where essentially the donor is putting the money into trust in the form of a loan. That loan is already always repayable to the donor. So whether that's on death, whether it's in the lifetime, you know, that loan is always going to form part of the donor's estate. However, all gains from the point of that loan being made, that investment within the trust, those gains are outside of the donor's estate. So two different ways to play trusts, but, you know, both of those structures are very, very useful for generational wealth planning, but, you know, retaining some benefit for the donor. So wrapping it up, I think, you know, quite a technical webinar, and I covered quite a lot there. So, you know, the key advice that I would give is to start the planning early. You know, we can't solve inheritance tax in one day. There's not one solution that is just going to, wipe the inheritance tax liabilities away, and do it in a very efficient way that you're preserving it, you're doing the best you can for your beneficiaries, and your bloodline. So using allowances early, if you use the £3,000 gifting exemption for 20 years, you've gifted away a lot of money, without sort of touching any of the other exemptions. Trusts and insurance policies protect wealth effectively. So the use of trusts and insurances together, they do protect wealth effectively. And I think, it is something we will be focusing a lot more on in the coming years, with all these changes sort of running in the background. Keep wealth outside the taxable estate where possible. So what I'm meaning there is, use trusts where you can, use different vehicles so that, it's not in the taxable estate. And that is both in your lifetime and after your death. The trust sitting between there, once the money's in trust, it's not in anyone's taxable estate anymore. And the final, and I think the most crucial point, is the communication and education across generations. So, lots of this planning is going to impact and have consequences, but, could be good consequences on younger generations, generations below you, different people in your life. That is a given when you're using trusts and you're using, gifting and these kind of tools. That if you're doing this, educate those people to the benefits of why you're doing it. That they can find the positives as well. But I'm going to leave it there. And I see there are some questions, which...
Yeah, we've got a couple of questions come through there. Some of them you might have already touched on, but I'm sure you can just give like a little recap as we go along. So we've got the first one from Maurice Lenders, I think it is. Regular gifting, what is required, i.e. amounts increase / reduce amounts?
So regular gifting, so I'm guessing that is gifting out of normal expenditure. So the gifting out of normal expenditure, so long as it satisfies these three conditions, any amount. So it doesn't need to be a fixed amount every single year. It's, based on your income is variable per year. So gifting out of income, normal expenditure, it's not at all a fixed amount. There, having a pattern of it is part of the exemption. That pattern could be annual, it could be monthly, and the consistent intention is there. So it doesn't, there is no stipulation that the amounts have to be regulated, so that they have to be within a certain monetary barriers.
Lovely. And then we've got, is it likely government closes gifting from income option or caps it?
Very topical question. There is lots of possibilities. I don't see it being completely written off. And that is because things like insurance premiums, how would insurance premiums be managed? There are things like that. The scope and the wideness of the current legislation, as I highlighted just in the previous question, could be looked at. There is a lot more stringent rules coming into play with inheritance tax exemptions. So I wouldn't be surprised if there is changes to it. However, I don't think it will disappear in its entirety.
And then, can you gift shares or is it just cash?
You can gift anything. So you can gift anything with value. So anything with value, you gift away. So jewelry even, you know, you can put a value on that. If it's, you know, if it's documented, that could be your gift. But shares, absolutely, it doesn't just have to be cash, no.
Is the £250 gift tax exempt, required to be paid direct to each person, or can they be sent a son or daughter to allocate out to grandchildren?
So in inheritance tax, the key is record keeping. So the key and the core activity will be record keeping, in the sense of, you know, where that gift is going, how it gets there, and keeping proof of those records. And, you know, the individual's intentions are clear, then that, you know, that I guess answers the question. It doesn't have to go direct to that person, but the intention of it, you know, and the reason for the gift would have to be very clearly laid out and documented and recorded.
Is there a time limit to wedding gift allowance? Does the gift have to be made in the same tax year as the wedding takes place, or could I still make a wedding gift to a child who was married 5 years ago?
It's a very good question. It definitely doesn't have to be in the same tax year, the wedding gift. Again, I will come back to you on that when I've got an answer. But my immediate response is that the same, you know, if there's a documentation and record keeping of when that gift was made, how it was made, you know, what the intention of that gift is, then, you know, so long as those records are clear and concise and logical, you know, that is what the sort of inheritance tax regime is based on. But yes, wedding gifts aren't tax year reliant.
Sorry, I've got a couple coming through. Retrusts. Can you set up a company pension to be covered into your trust to protect against IHT? Won't let me publish that one.
That's fine. Can you set up a company pension to be covered into your trust? So a company pension is going to be liable for inheritance tax. Yeah, a company pension is going to be liable for inheritance tax, and it's going to be within your estate for the purposes of inheritance tax. So even if your pension is written into trust, so i.e., you know, the benefit, you've nominated the beneficiary of your pension to be a trust, it still is going to go through the inheritance tax scope first. So I'm going to say no to that, but feel free to ask me in a different way if I haven't answered that question.
Regular gifting. Can I gift out of retirement income if I am depleting my savings, for example, for holidays, or is my regular gifting allowance limited to any income remaining after all my personal annual expenditure has been deducted?
Gifting out of normal expenditure has to be from income. So depleting savings does not class as income. So a simple answer to that is no, you can't gift away savings, even though there's a regular pattern of you encashing savings. Interest from those savings can be gifted away, however.
What is the definition of gifting? If I put money into my child's ISA, is this gifting?
Yes. Yeah, that is a gift. And, you know, usually that would be exempted out of gifting out of normal expenditure. However, you know, there is a lot more stringency being put on these. But yes, if contributing to children's ISAs, you know, giving children allowances, paying university costs, all of those things are gifting.
Are contributions to junior SIPs in addition to all other gifting allowances? Can multiple people who are non-family contribute?
Yes. Yep. Anyone can gift into anyone's pensions, ISAs, so junior SIPs and junior ISAs, can receive contributions from anyone up to obviously individual limits. So junior SIP, the limit is, well, to pay in is £2,880 per year. So, you know, you can't put more into one person's junior SIP than that. But it is all gifting, yes. And it is in addition to, so it would be in addition to other allowances. I mean, if it fell within the 3,000 exemption, you would use the 3,000 exemption. If it was classed as gifting out of normal expenditure, it would be gifting out of normal expenditure. If, for example, grandparents are contributing £250 to junior ISAs for birthdays, that can use the £250 small gift exemption.
Gifting out of normal expenditures. If you have a mixed overall income from both, say, a pension drawdown and sale of shares or capital from, say, a GIA, how do you demonstrate the gift to children was from the regular drawdown income rather than the capital withdrawal from a GIA?
You demonstrate it with record keeping. So going back to this again, you know, when you are using or when you are actively using gifting out of normal expenditure, you keep very clear records, you know, what has come in from where, what is income, and, you know, what are your expenses. So, for example, all of your living expenses could be deemed to be settled from sale of shares and capital from your GIA. Then, you know, your net income at the end, you know, you will be left with a number. That number can be gifted away, but it is all about record keeping. Keeping clear records is very, very key to being able to claim these.
Lovely. I think that is all the questions that we have at the moment, which I think has been our biggest Q&A session we've ever had. So obviously a very hot topic at the moment. With that in mind, I will just remind you that you will be receiving a copy of these slides and presentation. So whenever you sign up to one of our webinars, even if you can't attend it, you will receive a copy. So it's always worth obviously just signing up. But I'm sure if you do have any more questions that you can think of, feel free to either reach out to Claire directly or any of your advisors, or even send one over to info@ascotwm.com, and we can get that into the hands of an advisor and they can go through things with you as and when. So for now, I am going to pop the survey up. I'll leave it up for a couple of minutes. So if you do just have 30 seconds just to leave a little bit of feedback, we would really appreciate it. Otherwise, we will see you at the next webinar. Thank you very much, everyone. And thank you, Claire.
Thanks all. Bye.